You had a great report out, which we'll get to, about the super cycle. I just want to get your take on the Texas deep freeze and these numbers that we're getting and sort of when we can expect demand and production to kind of level out here.
It's going to take a while. We've got most of the production back online, and hence a bit of a big increase in crude oil inventories, and we don't have most of the refining back online. It takes longer, and it's more complicated to start up a refinery than it is to start up an oil production. So we have this massive drop, which was anticipated on the product side. That drop is going to increase margins. It's going to, as it already has. It's kind of sustainable for a while, for several months, which will increase demand for crude oil as more refinery comes back online. So yes, there will be an adjustment, and it does have global repercussions.
Right, and something difficult for producers and then OPEC also to deal with. Just staying in the U.S. for a second, when you have oil at 60-65, the E&Ps are going to talk about discipline, with the exception of, say, EOG Resources. Are they really going to deliver discipline at these numbers? And how do they compete with the private guys that are putting money in and pumping more oil?
Well, the private guys are really interesting. And yes, they seem to be putting more money in and pumping more oil and raising their rig counts. Thus far, they've kind of maintained market share, actually. Their market share now is about 48, 49, 50% of total rig utilization. That's what it was when oil directional drilling dipped below 170. That's what it was when oil directional drilling a year ago was in the 700 rig count rate for oil directional drilling. So they've kept the pace, and yes, they're showing what rational actors are doing. We really believe strongly that at price levels that we anticipate, including the ones that are there now, we're going to see more rigs going into the market, as they have been for the traditional players. They're a little late coming back in because of the disciplined path that they think the investor community wants. But at these prices, the investor community is going to change its mind. And the investor community is going to say, hey, this is short cycle oil. Short cycle oil is meant to be pumped when prices are high because they can respond to it and increase cash flow. So I suspect that the pressure points on the industry are going to change as we get into late spring, into the summer. We're going to see, we think, the rig count getting up above the level, not only which doesn't allow full replacement of the declines, but to the point where we have an increase. So our price deck leads us to believe that we're going to see 400,000 barrels a day of growth at the end of the year from the low point reached at the middle of the year, and then about 1 million barrel a day growth next year, all else equals.
And Ed, you got to wonder then what that does for OPEC. They're going to want to get ahead of that. I just want to show you this chart. If you can't see it, I'll explain it to you. It's U.S. daily output as well as an OPEC crude production. The white line there is U.S. The blue line is OPEC. You can see sort of OPEC rolling over, particularly as Saudis had that voluntary cut. And then you have the white line where you have a little bit of tick up within production in the U.S. How does OPEC Plus respond to this over the next 48 hours?
Well, they're going to respond to other things over the next 48 hours. They're going to respond to the pressure within the group to raise production come what may, because the price levels are what they are. And they're going to pit that against those, particularly the kingdom, which is looking for caution. I have told our clients that I would not invest in any way on this OPEC meeting. I think there are too many wild cards at stake, and we don't know the direction that things will take. But the directions that, whatever they take in terms of whether there's a rollover, as Reuters is reporting, or whether there's an increase, as the consensus is for an increase of 500,000 barrels a day from the OPEC Plus group come April 1, and an increase of up to 1 million barrels a day by the kingdom. I actually think that anything less than that in April will be a very bullish move. And the reason for that is because, as we just are seeing in the U.S. inventory, the oil world is a world of production and refining. And in that business, there are crude oil stocks that go down when OPEC cuts, and there are product stocks that go down when the refiners have not come back. We're at a very interesting juncture. In the month of February, there are many commentators who point out that seaborne Saudi exports were not down by 1 million barrels a day. They might have only been down by say 900,000 barrels, by 100,000 barrels a day. Now, why is that? That's because their refining system is in maintenance. So they may have cut production, but they have also cut demand at home. And this is a period of time when demand around the world by refiners, who are the only buyers of crude, has gone down. Come April, we expect Saudi domestic refining to go up by more than 600,000 barrels a day. That doesn't include testing out of a new refinery with a 400,000 barrel a day capacity. And we expect global refining to come back online, not just in the US, but in East Asia and around the world, and refining demand to go up. So if there's no big increase, there's likely to be a reduction of some Middle Eastern oil in the market at a time when refinery demand is going up. So it could be a fairly strong bullish statement. And if that's the case, the traditional buyers of crude in East Asia, South Asia, are likely to see them grumbling about the price. And I just note that at the IEF meeting that took place, the International Energy Forum, where the Saudi oil minister spoke about discipline, 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 the Indian oil minister came up to speakers after him and said, discipline means high prices for consumers. Consumers don't like that, and you better not do it. So we'll see what happens.
Ed, good morning. It's Guy in London. Just getting some comments from OPEC Plus, actually, the JMC ending without recommendations, according to delegates. Actually, I don't want to talk about oil. I want to, in my last question, just pivot a little to gold. Ed, yields are going up. We've got a 148 on a 10-year in the United States. We've been significantly higher than that over the last few days. Money is absolutely pouring out of ETFs. What is your outlook? How bad does it get? How much more downside could there be for gold?
Well, there could be a couple of $100 worth of downside, probably not more than that. There are other things going on besides the interest rate play and the rise of 10-year yields in the last 24 hours. There's more than that at stake because gold certainly does respond as a reservoir of value when interest rates are low. But it serves other purposes as well. We note that emerging market central banks are again buying gold. They've done that for the 10 years before the pandemic. We think they'll do that again. That's in part because of increasing concerns about where the dollar goes and about stability in terms of the dollar as a store of value and as a mechanism for settlement of international trade. So we have central bank buying going up, and we have jewelry buying going up after a kind of year-and-a-half pause on the jewelry buy. So we think gold will hit a bottom from its traditional buyers as the ETF, retail, and institutional investor move comes out of it because of the change in the macro environment.
Ed, you had a really good note out yesterday that talked about how some metals may be in a super cycle, but oil is not. You did make the case for bullish short-term oil prices. So I just wanted to get your thesis on kind of why we're not in this super cycle world where we do have some kind of reflation. We do have a reset in terms of carbon intensity and greening.
Yes, well, all in all, that's because oil doesn't disappear all that quickly. So as you know from that report, we mapped out 3 areas of projected demand growth. We took a historical curve, oil demand rising, very much the case now as it is. So we're bullish oil over the next year, maybe a little longer than that, maybe not, depending on other things. And that's because with the recovery around the world, a 5.5% recovery, we're going to see oil demand rising by about 5.5% or 5.5 million barrels a day year on year. And with numbers a little bit on the upside or the downside from that, that's kind of a consensus view in the market. And that's because with the recovery, you get a surge in demand where it's about 1% per every GDP growth number of 1%, you get 1% increase in demand for petroleum products. That's not normal. The normal 20-year trend before the pandemic was about half of that, a little more than a 0.5% increase in oil demand for a 1% increase in GDP. So yes, demand is going to be very strong on the growth side, given the low numbers from last year against the higher numbers from this year. And this may extend into 2022, especially if we have an increase in trade accompanying this. And trade tends to be, when it's growing, pretty damn diesel intensive, given the demand for diesel by trucks. But after that, it slows down. And then we have new policies that are already in place that came with the pandemic. These are seen particularly in Europe with the move by cities and governments to ban non-electric vehicles and the movement by auto manufacturers to stop making ICE vehicles. So we have, yes, a slowdown, and we think it'll go down to 0.4 to 1 rather than 0.5 to 1. But if we have more progressive policies in place, it can be even lower than that. You combine that with the low cost of oil, finding and developing oil and producing it, and that spells, in our judgment, oversupply.